Hello, listeners, and welcome back to Cognitive Dissidents. As usual, I'm Jacob Shapiro. I'm your host and the partner and director of geopolitical analysis at Cognitive Investments. Joining me on the podcast today is Mike Edwards. Mike is the deputy CIO at Weiss Multi-Strategy Advisors. We recorded this on Friday, November the 18th. I think this will probably come out at some point next week. I'm not sure if it'll be early in the week or if it'll be our Thanksgiving content for you, but it should be out fairly soon. Nothing too dated here. Otherwise, just a reminder, if you haven't left a review for the podcast, really helps us out. Takes a couple seconds. If you haven't done it yet, please consider doing so. Enough from me. On to the conversation. Cheers. See you out there. Cognitive Investments LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Cognitive and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.cognitive.investments. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. Mike, we've been playing a little, I don't know what it is. It's not phone tag, it's podcast tag. I have no idea. We had a power outage here in New Orleans. We had schedules and Google Calendars not communicating, but I'm glad you're finally here. It's good to see you.
Yeah, it's great to be with you.
So we're going to talk China and Europe, it sounds like. Why don't we start with China? I know that we want to get into more interesting things than the reopening, but I feel like we have to at least do 2 minutes on the reopening. So why don't you just tell me what your take is on the reopening and why we maybe shouldn't care so much about that and should be looking in other directions?
Yeah, well, I think this is the proverbial watched pot slowly boiling. I think there's been a conundrum that every armchair epidemiologist, which is basically every market participant over the last 2 years, has reached the obvious conclusion that a zero COVID policy is not actually a thing, practically speaking. And so when is reality going to meet policy in China? And thus, this sort of the demand that's been so quashed is going to be released. I think there's a view that is somehow binary. There was some thirst around the NPC, the Congress, that you would have, like a beach ball held below the surface of the pool, that all of a sudden it would pop up and demand would be unleashed. That hasn't really happened. And I think what you've seen is the ongoing, the extension of the contradiction, which is there is, of course, a desire to put up better numbers and allow demand to be to tick up off the lows, to provide an outlet for some of the dissatisfaction within the general population about the restrictions they've seen. But at the same time, epidemiological reality, not armchair market nonsense, the Chinese healthcare system is not even remotely equipped to handle tens of millions of COVID cases. And so they're in this bind where you have a wished for and an eventual policy, but how do you actually get there? And I think the consensus is that, they'll get there sometime in the next, let's call it 3 to 4 months. I think I would tend to agree that there's probably a bogey pointed at the other side of Chinese New Year. So call it early spring. Mm-hmm. But the problem, of course, is that, while everyone's rolling their forecast forward and starting to think about 2023 and how that's going to happen, we have to actually get there at a time when cases continue to tick higher. And so bridging reality to what are now market expectations, is sort of the growing problem in my mind. Whereas, if you go back to like a July, August timeframe, it was sort of, when will policy ever shift? When will the mentality shift? This is all about control, et cetera. I think we're off that kind of hawkish view. And when I say we, I mean sort of where the market consensus is. And we're on to something, probably glass half full from this output. And you're seeing, a lot of Western banks kind of trip over themselves to get glass half full on China now, within the last few days even, as the price action starts to work. But of course, price action is one thing and policy realities are another. And so how those square is going to be the big test over the next couple months, in my mind.
Yes, I think it was JP Morgan earlier this year that gave us that China was uninvestable. I'm sure that it's not uninvestable right now. I think that's an important point you made, though, about the Chinese healthcare system, which I think is being lost in some of this, because the best, the best analog we have for what China's about to go through, if reality is about to, meet the windshield of policy, is what happened in Vietnam. And a quote unquote COVID reopening policy is really just like a lot of people are going to get COVID really fast, and you're going to do,
Yep.
in a very short amount of time, what we've been doing for years, to our own detriment here in the West and in other places. And in Vietnam, that meant supply chains ground to a halt. That meant, companies were looking at their shoes, that not knowing what was going to happen for 8 to 12 weeks. Now, it was okay after that, after you had that sort of rush. But this idea that things are just going to, the Chinese government's going to do a policy and suddenly things are going to go well, there's probably a lot of pain that's going to happen before China gets to any kind of sense of normalcy, I would think. No?
No, I agree with that. And I think the pain is not going to be universal. And the means of, either anesthetic on the one hand or, powering through on the other is also not going to be universal. And I think that's particularly true because we've probably missed the window in which very high uptake of effective vaccines is in fact the solution. I think people got excited. I think it was maybe a week and a half ago when Olaf Scholz leaves a bilateral meeting with Xi and says that, expats are going to be allowed now to take the BioNTech vaccine within China. And I sort of laugh at that headline because market participants were thinking, well, maybe this opens the door to, a foreign mRNA vaccine for all of China, which we obviously haven't seen. And I think there's some major IP problems with that. But on the other hand, expats have been taking the Western mRNA vaccines already. This is the sort of, official crystallization of an already extant reality. And anyone who lived in or visits Hong Kong or Macau, and even many people in Beijing and Shanghai were already taking this. So, I think it was sort of a nominal win without there really being a material change.
Yeah, I can't argue with that. Well, let's not spend any more time on that, and let's talk maybe a little bit about what happened in Bali this week, the G20. We went from these semiconductor restrictions from the United States to suddenly a Xi Jinping that, it was subtle, but I found him to be much more, conciliatory is the wrong word, pragmatic, friendly, open. Even that video of him chastising Justin Trudeau.
Yeah.
It was pretty polite for a talking down to. So did you see some kind of change in tone there, some kind of change in approach?
Yeah. So a couple of things. And I totally agree that this was an important, we'll call it an important display. Let's start with something obvious just to bridge these two topics. There was no mask. And the Chinese delegations were frequently videoed without masks on. That plays importantly to the domestic audience within China of literal and figurative openness and again, literally and figuratively showing face, right?
Yeah.
Even just to contrast that with the much videoed, NPC conclusory meetings as they open it up to the foreign press. Other than the front row of leadership, everyone there was wearing a mask, right? In the Great Hall of the People.
Right.
And I think there's a neat contrast to and I've used this word several times to describe both that moment with respect to Hu Jintao and the general tone of appointments and that sort of thing as being brazen. I think brazen is the word that in my mind best describes both the intentional display of what the power consolidation looks like, as well as all of the imagery around it. And I thought that what was happening in Bali was a nice sort of soft contrast to that. It was a real comfort with other world leaders. I think there was commentary from several people that, and I think this was the general takeaway, that he was at ease and conversant, and then was, to your point, was not afraid to chastise a Trudeau. I think that there was a given. My understanding is there was a give and take in the bilateral meeting with Biden, and it wasn't this was neither some grand coming out party of China, nor was it a putting the dragon back in the box sort of grand metaphors. This was sort of business as usual. Here we are, and that may seem unremarkable, in the grand scheme of things, but for a China where business has been anything but usual for the last, certainly in 2022, but even arguably for the last 3 years or so, that sort of, nothing to see here, diplomatic, bent is in fact remarkable.
Yeah, well, it's a fairly surprising show of restraint too, because it wasn't that long ago that Pelosi was in Taiwan. These semiconductor restrictions are going to hurt China, and they came out even more recently. Is it just pragmatic? Do you think China thinks that it can get some of these restrictions or some of these things to be lessened a little bit? Do you think it's? What do you think is behind? Is it as simple as Xi got his coronation at the party congress, so now he feels comfortable doing some of those things? Like, do you have any sense of why the shift out of China to business as usual?
Well, so let me separate those things. I definitely have sympathy. This is the opposite of a hot take, but I definitely have sympathy for the view that with both Biden on the one hand and Xi on the other hand, over the political milestones respectively of the midterms on the one hand and the NPC on the other, that the pressure to be performatively nationalistic is a lot lower. And I think that those pressures are, they come from very different places, but they are equally forceful on opposite sides of the Pacific. And I simply think that because you've had that political outlet or the release valve of those events, that there's not such a requirement. But I also think that it's important for both administrations to, if I'm speaking in the language of stock charts, right, to consolidate at the lows. This is the worst that Trans-Pacific relations have been in generations. But they were, let's be honest, to your point, around Taiwan and on several other topics, which, and we can talk about Taiwan as well. But in my mind, the restrictions around semiconductors are probably more damaging than the, tracking Pelosi's flight from the Philippines to Taipei or whatever, right? That kind of, those kinds of visuals and symbolism. I think it's important for both sides to stop the spiral, because I'm of the view that the real risk around South China Seas and anything to do with Taiwan, it's not things that are intentionally kinetic. It's actually accidents. And the way to stop the spiral is to have better track two diplomacy, to open lines of communication that had previously been closed. And to build, it's not necessarily trust. It's in some cases the actual red phone, right? To from both a military and a diplomatic standpoint, to have outlets. And I think you go back to, we're now very far away from the early days of the Bush administration, when, if you remember, the spy plane that had been shot down by the Chinese, and Condi Rice had to defuse that, and there were no open lines of communication. Like, that was a little, it feels like an eternity ago, but that was a little mini crisis. Imagine what that same incident would look like today if you had a U.S. spy plane shot down over the South China Seas. That would be you could run from a market standpoint, you could run the red headline exercise. That would be, to me, bigger than a couple of errant missile parts hitting Poland and things like that. I think it would be much more severe. But on the other hand, you could also imagine that the unintended consequences could build on themselves. And so I think having mechanisms to prevent that from happening has been important. And this has been the first moment in quite a while. We've had both sides building towards that. And if that's a bookend, I would put the other side of the bookend to be maybe, Jake Sullivan's meeting with Wang Yi and others in Alaska, which was by all accounts very tense and was more about, comparing the size of middle fingers, as it were, and thus like really pushing communication apart as opposed to making it more possible.
Yeah, I mean, that's a good thing for sure. Let's leave the China-U.S. stuff and talk about the things that I actually think are the most important things happening in China right now, because there's the reopening play, there's the Xi Biden stuff, there's Taiwan, there's all this other stuff. But in the last couple of weeks, we've gotten this pilot program on tax reform in China, which sounds to me like they're going to experiment with ways to redistribute wealth, and then this 16-point plan to try and figure out how to get the property crisis from spiraling out of control. Speaking of spirals. I know that, beforehand, before we hit the record button here, you were saying you weren't that constructive about China for the next 2 years, or optimistic about China for the next 2 years. And I'm assuming that some of that has to do with this property crisis that is threatening China in the face. So why don't I lob up that softball for you and you take it in whatever direction, and then we'll find our way back from there.
Yeah, I think let me parse that into two parts. The property thing, it's the thing. It's a big thing. Let's table that for a second and talk about flows for a second before that, because I do think there's increasingly, from an investment and from a market standpoint, there's going to be a distinction between investment flows within China and how global flows interact with China. And I do think that in some ways, and as you referenced a minute ago, the sort of grand statements like China is uninvestable by JP Morgan at the beginning of the year, which has since been reversed. I think there is a growing consensus among global allocators that at least domestic China is uninvestable, and that the predictability of the regime from a rule of law standpoint, from a repatriation of, from renminbi to dollars, basically, or euros, is increasingly difficult and undependable. And I think that the last pillars of hope, as it were, from reformed Sinophiles, and I would count myself among them. I mean, people who've spent the time to learn Chinese, been involved in those markets, tend to, I think there's an embedded bias towards engagement, because they've obviously been, in many cases, personally invested in engaging in investment flows and in economic flows. But I think the People's Congress sort of extinguished some of those last fires of hope, because there was really very little pragmatism or checks on Xi Jinping that were in place there. And I think even though you did see, and this is sort of getting the distinction between domestic markets and global markets, even though you did see, in particular, some of the tech names stabilize post the NPC, I think overall, and this would be the sort of 2-year view, I think there will be increasing allocations away from China from global allocators. Having said that, coming to the property piece, I think within China, you're going to see allocations away from real estate and property, to some extent from institutions, but most importantly from individuals as means of wealth preservation and creation. You're going to see movement away from the property sector and towards credit and equities and other instruments. And I think increasingly that's going to have to be encouraged by the administration, because they have a major demographic problem that pairs with them, obviously major property, frankly, solvency problem. And they continue to, and when you talk about the 16 measures that were introduced and the backstops and things like that, at a very high level, my view is they're trying to address a solvency problem as if it were a liquidity problem. And secondly, I think they're addressing a much larger demographic problem, with which also gets to how do you create savings, and incentives to save, that motivate a younger generation rather than entrench the existing wealth of the older generation, which has for the most part been in the property space, and just can't be extended and extended and extended, while you have 20-25% unemployment among people in their 20s. Those two things cannot continue to coexist with sort of a fixed pool of savings in an economy that is growing at much more normal, like low single digit rates, but had been built on nearly double digit rates of growth. I mean, this is a really important time to reconcile those two things. And I look at it through almost a demographic lens of having to support what would be the Chinese equivalent of baby boomers, while at the same time trying to incent the youth and give them opportunities to create, and to your point with the tax experiments, in some cases redistribute wealth. So I didn't hit that softball with a flat bat. I guess I sort of went in a bunch of different directions, but
no, it's good.
But I think it's a really complicated time from how to think from a policy standpoint in Beijing about what asset classes to incentivize and what to sort of draw from for redistribution and stabilization purposes.
Yeah, I don't envy Chinese I don't envy policymakers in general, but I especially do not envy the policymakers in Beijing. They have some very, very difficult needles that they're going to have to thread. And I mean, we've already one of the reasons that the average Chinese person is invested in real estate is because that feels safe. Like, it's what 2015 was the great stock market collapse, and that was also a bad moment for Xi Jinping as well. So you want to tell people to go play Russian roulette or Chinese roulette in some of these Chinese indexes. I mean, that's hard. But I wanted to go back to something you said, which was that they were addressing a solvency problem as a liquidity problem. Help me understand what you mean by that, because to me that it's close to a distinction without a difference. So I must be missing something in what you mean by addressing a solvency problem as a liquidity problem.
Well, I guess what I mean by that is the approach right now is, and this is, listen, this is tried and true. We can go all the way back to, the Chinese solution to the Asian financial crisis in 1998 in the creation of asset management companies and debt equity swaps, right? From a capital structure standpoint, the Chinese have generally, this is a big generalization across a long period of time, but they have been very good at equitizing things that wouldn't work as credit instruments, right? That in particular, bank loans that go from secured to unsecured, and then from unsecured to equities, and then you inflate a balloon and you hope that whatever those things were somewhere on the balloon, and then you can cash out, right? And like those really are can kicks. You're not actually, there's no financial alchemy there. You're just delaying the inevitable, as it were, right? And I think a part of the approach right now, in terms of basically forcing the banks, the state-owned banks, to backstop the property developers, so that the developers can complete the buildings that were uncompleted, and thus, ideally, if prices are relatively stable, to avoid the discontent associated with some of the mortgage boycotts and things like that. But on the other, to at least have the free cash flow to not have empty pillars in the sky and that sort of thing. What the loans to the banks are doing is allowing the loans to the property companies, not the banks, the loans from the banks, is allowing them to then go out and either issue more unsecured debt, or in some cases issue equity. Like over the last week or so, and I'm not sure where that's going to show up as you timestamp this, but over the last week or so, we've seen a couple of pretty major equity issuances from the property developers, which has happened because they've been supported. And so what you're getting is the banks pumping liquidity into what are ultimately not really solvent entities, but it allows them to, in the language of the credit part of the capital stack, amend and extend, and thus push those maturities out. So what we haven't done is, and listen, this is a time, like, regardless of the across the spectrum from the, perma bears to there aren't that many perma bulls on China anymore among writers in the English language, right? But regardless of who you read, everyone would acknowledge that the property phenomenon, right, is one that requires a pyramid scheme is the glass half empty version,
Yep.
and sort of flywheel is the glass half full version. But they would all acknowledge that you're built on the requirement that there be ongoing velocity of an ongoing turnover, and that, like, that's not really what's happening anymore. Everything's screeched to a halt. So the question becomes, how do you restart it? And what's not happening in any of these reforms is a change to the model, right? And so whether you're at the half empty or half full, the bullish or the bearish end of that spectrum, you have to acknowledge there's a moral hazard problem. The sector has been bailed out, I don't know, I'm going to go with 8 times in the last 24 years, 25 years. And there hasn't been a fundamental change to the business models here, even as most of the equity charts over that period of time have pointed, like, down and to the right. So something's got to give here, but it's not giving in the current moment. So that's where I say you're solving I use the word solvency, but it's a fundamental. It's not a business model company by company. It's industry wide. You're trying to address that by pumping more money into the system. That's probably not it's not a lasting solution.
Is there a solution at all?
I mean, I think that, like, listen, if easy to say, I don't envy the policymakers, but I think the cross-generational solution, the long-term solution, and the major advantage that there are many major advantages as policymakers have, but without getting into any of the things on the sort of autocratic spectrum, right? The major advantage that Chinese policymakers have over Western policymakers have is they're not subject to election cycles and the sort of myopia that's built into the feedback loops that we're accustomed to, especially in the United States. So they can think in 5 and 10-year terms. That doesn't always work, but sometimes they're at least equipped to think that way and plan in that way. And over that kind of time frame, I think the solution is to push savings out of the property sector and into, in particular, equities and credit, ideally by a proper, not sort of wealth management products and things like this, and but a properly syndicated non-bank credit market, as it were. So effectively, greater financial intermediation is part of the eventual solution here, to have the wealth of the Lao Baixing, the wealth of the average Chinese person, not so dependent on the price of the apartment that they bought and hope goes up in value.
Well, before we turn away from China, I mean, we talked about the policymakers being able to think in 5-10-year increments. How are you thinking about China in a 5 to 10-year increment? Do you feel optimistic that by 2030 things are looking better for China? Are we embarking on a lost decade, or is it something worse? Help me think through the end of the decade how you're thinking about China.
Well, this is going to be a very unsatisfying answer, but I think as an outside observer, the Chinese the water has almost never been murkier in my time sort of studying and engaging with China over, let's call it 25 years or so. It's more difficult to see, or I should say there are more binaries built into the next 5 years than I think there have been in almost any 5-year stretch going back quite a while. And I think we returned a little bit to the sort of U.S.-China component, but I'm a little bit more sort of positive sum than the Thucydides trap, like zero sum mentality is when it comes to, framing the U.S.-China relationship. But it's certainly as antagonistic as it has been at any time since Deng Xiaoping. And that is how that plays out is extremely difficult to predict through a long lens. And then I think there's another issue is that the demography has shifted so much from even just 10 to 15 years ago that we're now at a point where there will be, in that 5-year window, there will be more retirees, or at least people of what would traditionally have been retirement age, depending on the wherewithal of their savings, right? In China, in the next 5 years, then there will be people entering the workforce. And that's also happening at a time, like that would be one thing if China was effectively at like minimal unemployment. But that's at a time right now where economy-wide unemployment, depending on which statistics you believe, is in the mid to high single digits. Mm-hmm. And among the youth, among college graduates, it's in the 20s. So you have a sort of a building potential dissatisfaction there. And there have been various, sort of movements. The English is the lie flat movement, and other, just kind of little windows into the sort of frustration and in some cases disgust that the youth feel with that picture. But that demographic dynamic is very different, and it's hard to predict how that will play out over the next while. Having said all of that, I've throughout my career I've learned you don't bet against the wherewithal of Beijing. I in the same way that we sort of assume until further notified that there's a Fed put. Currently, we're under notice that there isn't. In a similar vein, you assume there's a Beijing backstop, including for the politically sensitive sectors, of which obviously property is one, and that I think remains true. So while I think in trader speak, I would definitely not sell vol on China over the next 5 years. I think it'll be a volatile period, but I also think it's a waste of money to buy crash puts or to buy puts from here, because I think it will remain a very carefully managed economy, and I think the forces that are working against them tend to be more exogenous than bad policy per se.
We didn't talk about this beforehand or before you came on, so if it's too much of a curveball, that's fine. But how does that, I mean, you spoke about the demographics of China. Are you more constructive on Japan? Do Japan's demographics scare you? Does Japan's experience over the past 30 years give you hope or give you more fear about what's about to happen in China? Because it seems to me that Japan is the one that is going through all of this first. And I see interesting things out of Japan right now. They seem to be, it's one thing to have the population decreasing, but if you can have growth, decline slower or grow slower than population is declining, like maybe there's some way you can square that circle. So what do you think?
Yeah, I share that view. There's no pushback from me. I mean, I think Japan sort of in many ways on the demographic front has like let's call it a 20-year head start on China, I mean, plus or minus. And you asked me before, are we going to see a lost decade? I mean, that's obviously drawing from the Japan experience. In some cases, more than a lost decade. I think there are some big asterisks required around being constructive on Japan right now. One of them is it's obviously, at a minimum, sort of the first derivative of Chinese growth, because such a large part of their export economy is to China. Now, I think that's something that, given the degree to which, I think it's not just COVID. I think there's a lot of other ways in which I actually believe in the analogy of the beach ball held below the pool surface, that I do think you will see spurts of growth. And I think Japan benefits a lot, actually, from from kind of the duplicative CapEx phenomenon that comes from the U.S.-China, let's call it a divorce or, re-regionalization. Japan powers global CapEx. So when we are in a global CapEx supercycle, Japan does well, Germany does well, and I think we are in the relatively early innings of a global CapEx supercycle. Of course, that we can then have discussions about, well, where does that put us from a capacity standpoint and things like that, which is maybe worrisome over time. But those two forces maybe compete with one another in terms of the push and pull for the global demand side for Japan. On the one hand, you're prone to, if when China catches cold, Japan has pneumonia. On the other hand, when everyone's building to replicate extant capacity because they're worried about resiliency and supply chain security and this sort of thing, that's good for Japan. The other asterisk I would offer is just I'm not even sure what to call it. I'll just call it the lunacy of their monetary policy right now. It's describing. I mean, everybody else if the demography lagged by, if Chinese demography lagged Japan by 20 years, Japanese discussions of the concept of transitory are lagging the rest of the world by, I don't know, let's call it 6 to 12 months. And like, listen, maybe right in the end, it gets harder and harder for me to see, but the obstinacy with which they are pursuing a dovish monetary policies is quite amazing. And I think there's like a 30 delta that they'll thread that needle and be very right. And there's a 70 delta that there'll be I don't know what the Japanese equivalent of a come to Jesus moment is, but that could be very expensive.
Well, we actually talk about this a lot internally at CI. I mean, Japan actually released CPI today for the previous month, and it was 3.6% year on year. So that's a 40-year high. But like Japan has been,
which in many cases is sort of to be celebrated. Like we've been working on engineering this in Japan for.
Yeah, they've been trying for years to try to even get
exactly.
about 2%. So my point is it's not crazy. It's not crazy monetary policy because they haven't really had inflation yet. Now maybe it's coming. I would expect that we're having the Bank of Japan governor is outgoing. Kishida gets to appoint his new person. If inflation in the next print is 4%, now we're double the target. Like, do we start worrying a little bit? But it doesn't seem to me that Japan needed to do anything quite yet, which is what that made sense to me coming out of the Bank of Japan.
No, I don't. My criticism is not that they've needed to do something. It is how long can this last for question, right? And I do think they're relatively dependent on global soft landings to have their current policy extend past Kuroda and sort of let's call it indefinitely. I guess maybe, and it's sort of at the risk of allowing my flag to blow with the proverbial market winds here. I do think this is happening at a time when you have the general re-empowerment of bond vigilantes globally. Some of them, if you just think about like P&L chip stacks among various strategies, like macro strategies have had a good year. You had sort of learned vulnerabilities around the pound and gilts, right? And if you think about where there is perhaps the most pronounced vulnerability for kind of gap moves, I think people target the yen on that basis, and whether that and maybe that targeting is overly consensus, and frankly people have targeted the yen. My colleague Lundy would say people have been targeting the BOJ for a career, and most of them have never made money doing it, so why would this be different? And I have plenty of sympathy for that view. I guess the reason I'm focused on it is because I do think that I think the tensions will grow, and I at a minimum would want to be in the business of predicting volatility, even if it's not skew or not getting the skew right. I think volatility is coming.
Yeah. Well, that's a good segue. You talked about the global CapEx supercycle. We obviously are very bullish on Europe here at the Cognitive Dissidents podcast. I've been joking. The first half of my year was not very good from a geopolitics perspective. Boy, did I whiff on Russia invading Ukraine. Boy, did I whiff on Iran rejoining the nuclear deal. But I'm coming on strong at the end of the year. And I've come on so strong with the Europe thing that when everybody was doom and gloom, 3-4 months ago on Europe, I would say no, Europe is fine. It's gone so well that I'm almost waiting for the other shoe to drop. I didn't think it was going to go this well. I thought we were still going to have problems. But it sounds like you're also constructive on Europe. But I also wanted you mentioned the global CapEx supercycle in Germany, and that is something I'd really like you to dive into because all I hear from either concerned clients or if you read the media, it's all German deindustrialization and the German supply chain is going away and German companies are dying. And it's just like, I feel like I've seen this movie before. Like we were calling them the sick man of the euro in the late 1990s. And look what they did. You're really going to bet against German industry? I think I'll take the other side of that. But tell me why you're feeling good about Europe right now.
Yeah, I call bullshit on that death of the German industrial or German deindustrialization. Like, just no. Mark, look, we don't really need my opinion here. Markets don't lie, right? Like the DAX is up 25% from the lows. It's outperformed the S&P by 20% since the end of March, which is sort of when we digested the Ukraine conflict. In France, the CAC is, you're watching the 50-day cross the 100-day cross the 200-day, right? It's from strength to strength. Like the market is telling them, the market is discounting the future. The commentariat is still wrestling with what's just happened and where there's, it's not just fighting the last battle, as it were. I mean, obviously we have a pretty significant shock to the system with a literal war on the European continent. Having said that, like you have now seen, you've certainly seen adjustments in the budgets of some of the larger EU member states. To the extent eventually, and let's just spend a moment on the jump of defense expenditure, the more or less trebling of defense expenditure under Olaf Scholz, who, by the way, is like the least likely German political leader to be doubling or trebling defense spending, and thus has some credibility in doing so. But like over the medium term, that's gonna be Europe buying from themselves. Like they're not gonna be buying, they're not gonna be buying Lockheed Martin and Boeing planes for the most part. They're gonna be buying from Airbus and Dassault, and et cetera, right? And part of that also is that I think, and this is not like on the defense side, by no means a certainty, but I expect Europe to shepherd the expansion of NATO and sort of refortification versus sort of the kind of Eastern realities. And I think there's an acceptance on the continent that the U.S. is going to turn more and more attention towards China and won't be powering that phenomenon. So as you're getting these budget moves, the expenditures are on, you're expanding, and there's all sorts of fiscal questions around this, but you're expanding demand for European goods from a CapEx standpoint, from a defense standpoint. But I also think just in terms of general resiliency, like the awareness that you have to backfill some of the infrastructure for less energy dependence on Russia and more and accelerating green spending and renewables expense, and maybe we leave nuclear, at least in Germany, out of that for a moment. But these in some cases floating LNG terminals, and in other cases like new LNG builds, which were not supposed to be part of the former kind of ESG agenda. Like these are not cheap to build, and they're being built in Europe. You can't offshore that capability. So I think that across all of these, the incremental expense is to backfill the infrastructure needs to support the existing industrial base. And I don't think it chips away at that base because we've weathered the storm already. The trough margins are in, right, in terms of what energy input costs are doing and what the sort of inflation prints are doing to European corporates, is particularly in cyclicals and industrials. And I think to the extent they've weathered that proverbial storm, you're going to see upticks in places, and that is if I had to give you a narrative for why are we seeing such turns in equity markets in Europe, I think that's a big part of it. And then we can sort of debate whether the some of the monetary policy side, but I mean, at the end of the day, like if the pushback on both sides of the Atlantic to long-term real rates being continuing to climb in the way that they had for the prior call it 4 months. I mean, listen, Europe has a much, in my not that educated view, but relatively educated view, has much more fragility in terms of the overall fiscal picture and a lowest common denominator problem, as well as a more fragile credit impulse among the banking system than the U.S. does. So, do I really think that Europe is going to indefinitely punish via a cost of capital? That fiscal impulse, that lending impulse? Absolutely not. I mean, it may, we can debate about what the next couple of hikes look like and how they stabilize things. But indefinitely, I just don't see it in terms of where the ECB will ultimately, depending on your perspective, either blink or return to its accepted role within a monetary but not fiscal union.
Yeah, I mean, Europe has had two of its illusions shattered in the last couple of years. The Trump administration shattered the illusion that the United States was a dependable ally, and the Russian invasion of Ukraine shattered the illusion that there would be cheap Russian natural gas for Germany and Eastern Europe in perpetuity as long as you didn't piss Moscow off or you didn't go beyond the pale and welcome Ukraine into NATO. And you put those two things together, to your point, like Europe has a very simple choice here. They can either grow and invest and do all these things, or they can fall apart and die, and they can be picked off by these different powers that are around them. And for me, the geopolitical argument about it is just as simple as I don't think these European nation states are going to choose to die. I mean, I guess it's possible. They're old and maybe they're past their peaks and things like that. But I think if you're thinking about Europe, or you're thinking about this energy crisis as being the end of Europe or the end of German industry, just like that's what you're forecasting. You're basically saying that Germany's going to give up. And I don't know. I've never known the Germans to give up.
No, I tend. I'm sure we could make a joke about that, but I tend to agree. And I think also you have, there's a third phenomenon or exogenous phenomenon that reinforces that, which is Brexit.
Mm-hmm.
I mean, one of the greatest own goals, just in terms of, it's not that Brexit was the UK giving up necessarily, but I certainly would consider it a policy own goal, especially from a trade standpoint. But if you're Eurocentric, the way in which Brexit has unfolded has absolutely supported your case for how important unity is and how important sort of fair trade terms are and leverage in trade are. Because look what's happened to, in many different shapes, look what's happened to the UK since then. They're now in a position where they don't have leverage versus the US. They don't have leverage versus the EU. And I think that reinforces the case as well. So, I was actually just in London for the last 2 days, and there was a lot of lament that the French stock exchange is now larger in market cap than the LSE. Euronext is now larger in market cap than the LSE, and what does that portend for the future? And how? I mean, I think that is completely the sort of market manifestation of what Brexit has done to sort of the locus of securitization, and where kind of predictable policy is going, in terms of the importance of a trading block and a financial block that's not quite the size of the United States, but not that much smaller.
Yeah. I was in Dublin, I guess a month ago now, time flies. And I was there right around the time that Liz Truss was competing with the head of lettuce to see who was going to last longer. And by the way, Ireland was an incredible place to be during all that, because the Irish, for obvious reasons, were having a very nice time comparing the lettuce head to Liz Truss. But I got a question when I was giving a talk in Ireland that has still kind of stuck in my craw, which was somebody asked, because I was very bearish on the United Kingdom, and I was saying I'm not even sure there's going to be a United Kingdom in 10 years, and I was going down that whole analytical route. And somebody asked me, well, do you think the UK could just reverse Brexit? Do you think I could get a new government that could just decide to say, just kidding, we'd like to come back? And I don't think at all that is the most likely possibility. I think it's a fairly minuscule possibility right now. But I did stop in my tracks because I hadn't thought of that. And they still technically could. And if this, like the Tory government just showed us that they're willing to do U-turns. So, I mean, it's one thing to sort of U-turn on a mini budget. It would be quite another thing to U-turn on, being a part of the European Union. But in the back of my head, I'm wondering if the UK doesn't quite realize that the answer to all of its problems is right there. You get rid of the Scotland problem, some of the Northern Ireland all these things go away if you just change your mind about this thing that has been relatively bad for you. But I don't know.
Yeah, I mean, I think some of the pickle there is the coalition forming requirements of parliamentary government, right? Where, what will transpire at the next election, whether that's in 25 or for whatever reason earlier, is the exactly your point on Scottish independence as well as Northern Ireland. Is those votes are going to matter a lot, right? And so you almost get a preview of the question, right? But it becomes, I hadn't really thought about this either that much, but I think it becomes circular in the sense that if you have Tories continuing to oppose, and if they poll anywhere near where they are right now, you can almost, if you get Labour courting Scotland and Ireland on the basis of reversing Brexit, then that sort of forms a coalition that has that mandate. But I don't know if that's going to be the key question, because the push for independence is so strong before that it may be a sort of a sequencing problem in the end, right? That Scotland would be, I mean, part of the argument, right, is Scotland can compete sort of within the United Kingdom much more effectively if it's part of the European Union and the rest is not. So there's a lot of fun moving parts there. But it is certainly, I mean, in the time, I've spent a lot of time in London over the years, and I have never had, even if I just go with the cab driver test, right, I've never had a greater willingness for, just strangers as well as in kind of cocktail conversation or whatever, to just go straight to politics. And they all start with some version of, bollocks this and it's a shambles that, and some great turns of phrase there, but everyone is sort of putting their hands up. So I think it's we're almost fighting these battles long in advance of 25.
Yeah. Mike, anything I didn't ask you before we get out of here?
No, I mean, the one thing maybe we could just come back to we were talking about capitalizations and the European question. I mean, the sort of, I think I've heard some of the reasons in your podcasting and the general thinking within CI on Europe. One flow of funds point I would make that has led us to be constructive Europe, maybe for different reasons, is if we accept for a moment, which is a big assertion, but if we accept for a moment that the U.S. mega cap tech bubble continues to deflate, who benefits from that? And we think that one of the biggest answers is actually European cyclicals and Europe in general. Just to sort of put that in numbers, at various points earlier in 2022, the 7 largest U.S. tech companies, right, which would be Google, Amazon, Apple, Microsoft, now Meta, Facebook, Tesla, and NVIDIA. Those 7 companies, their market cap was larger than the entirety of capitalized Europe at various points, which is really an incredible statement, right? Yeah. And, we could talk about COVID beneficiaries. We could talk about, disparate valuation metrics and this sort of thing. But what has been happening fairly violently over the last 3 or 4 months is those differences have been yawning. And I think you're going to continue to see a rotation out of that U.S. tech sector for a variety of reasons, including where real rates are and where sort of the terminal rate ends up and what that does to, traditional valuation phenomena. You're going to continue to see rotation out of that and into places that have longer dated moats with higher free cash flow yields, more dependable margins, more dependable end markets. And in some ways, it's been a deficit for Europe for the last 2 decades to not have any huge tech companies that dominate the indices, the ASMLs and whatever aside, right? In this rotation, that's an asset because there's no, there's no sucking sound from European tech. And so I actually think that may be an underappreciated phenomenon, but I think it's an important one in understanding the potential to extend the kind of rally in Europe from here.
Yeah. Well, Mike, this was great. Thanks for bearing with me on getting the recording together, and
good
we'll talk
fun.
to you soon, okay?
Yeah, appreciate it.
Thank you so much for listening to the Cognitive Dissidents podcast, brought to you by Cognitive Investments. If you are interested in learning more about cognitive investments, you can check us out online at cognitive.investments. That's cognitive.investments. You can also write to me directly if you want at jacob@cognitive.investments. Cheers, and we'll see you out there. The views expressed in this commentary are subject to change based on market and other conditions. This podcast may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur.